In this example, we're going to look at how different transactions we've learned so far affect the financial statements. So in this example, it says AC Service Company was formed on January 1st, year 1, and they want you to show the effects of each transaction on the financial statements. In the previous section, we looked at how each transaction affected the accounting equation, and then we went and prepared the financial statements so you know what belongs where in each of the financial statements. From this chapter on, what we're going to look at is how each transaction affects those financial statements. Most of you are business majors, so what's really important is to know how these transactions affect the bottom line of the company. And if you learn this, this will really help when you go get your jobs and you are aware of how every transaction that occurs impacts the financial statements. If you are an accounting major, this is crucial for you to grasp because later when we do debits and credits, it will give you a deeper understanding of why we do things in a certain way. For most of the course, we're going to look at different types of transactions and see how they affect the financial statements. The three financial statements we're going to look at is the balance sheet, and you know that the balance sheet has assets, liabilities, and stockholders' equity. We're also going to look at how each transaction affects the income statement. You know that the income statement is where you have your revenues minus expenses giving you net income. And then finally, we're also going to look at the statement of cash flows. We're going to just look at whether a transaction affects the statement of cash flows and what type of transaction it is. In this analysis, we're not going to be looking at our fourth statement, the statement of changes in stockholders' equity. However, when I ask you to prepare the formal financial statements, you will have to know how to prepare all four statements. After that long detour, let's go back to the question. It says AC Service Company was formed on January 1st, year 1, and they want you to show the effects of each transaction on the financial statements. The first thing I always ask you is, who are we? We are always the company. We are AC Service Company. And when were we born? When were we formed? We were formed on January 1st, year 1. So this is our very first year of operations. Just as we were formed on January 1st, year 1, before any of this transaction occurred, all the accounts have zero balances. All the asset accounts have zero balances, liability accounts, stockholder equity accounts, revenue accounts, expense accounts, all have zero balances because the company has never had a transaction before. The very first transaction is transaction A. So let's take a look at that. For transaction A, it says ABC received $90,000 cash from issuing common stock. So now what we're going to see is, how does this transaction affect these three financial statements? Earlier we looked at how they affected the accounting equation. Well, the accounting equation is there in the balance sheet, so the transaction is going to affect the balance sheet in the same way as it affects the accounting equation. But now we're going to add the income statement and statement of cash flows. For transaction A, we know that cash was affected by this transaction. So cash is an asset. Under assets, I'm going to type in cash. How was cash affected? Remember, we are always the company. We are looking at things from the perspective of the company. Our cash increased because of this transaction. Since it increased, I'm going to put $90,000 as a positive number. What else happened in the balance sheet? We know that for each transaction, the accounting equation has the same balance. So therefore, in the balance sheet also, it's going to affect two things. What is the other thing it's going to affect? Our stockholders' equity increased. What particular component of stockholders' equity? We know that common stock increased. So I'm going to type in common stock here. And before this transaction, common stock was 0. Now our common stock is 90,000. So I'm going to put a positive 90,000 here. That's how that transaction affected the balance sheet. When you're doing your homework, if necessary, read the instructions. You may have to put NA for all the other columns. Now let's see. Did this transaction affect the income statement? Is this a revenue or an expense item? It's neither. So because it's not a revenue or an expense item, it didn't affect the income statement. So we leave that blank or put NA if you're doing your homework. How about the statement of cash flows? Did this affect the statement of cash flows? Yes, it did. We know our cash increased. So if our cash was affected, our statement of cash flows affected. Cash increased by how much? It's a cash inflow of 90,000. So I'm going to put that as a positive number. And then they want to know what type of cash flow. So we know that the statement of cash flows has three types. Operating, which is from day-to-day activities, cash flows from day-to-day activities. We know it has investing, which is buying and selling of long-term assets. And then we know that there's a type called financing, which is whenever a company has stock transactions or company borrows or pays back loans, and then also dividends. So this was relating to common stock. Therefore, we know that it's going to be a financing activity. If it's financing activity, I'm just going to abbreviate it as FA, financing activity. Now we're done with that transaction. Let's look at the next one. I just realized that there's a typo and it says ABC instead of AC. So I'm going to quickly fix that. There we go. It's fixed now. For transaction B, it says AC company received $300,000 cash by borrowing money from a creditor. So let's see how that transaction affected the balance sheet. We know that when the company received cash, our cash increases. So we're going to increase cash by $300,000. Next, what else happened? The company just went into debt. So now we have a liability. What do we call liabilities when it's a loan? We call that notes payable. So under liabilities, I'll just put that here. We're going to type in notes payable. That's a column header. In the notes payable account, we know that our notes payable increased. Why did it increase? Before this transaction, we didn't have any debt. Now we have $300,000 of debt. So let's go ahead and put that as a positive number. And that will keep our accounting equation in balance. To remember, for each transaction, your accounting equation still has to stay in balance. That takes care of the balance sheet. Now let's see whether this transaction affected the income statement. Well, this is not a revenue item, nor is it an expense. It's a note payable, which is a liability. Therefore, it does not affect the income statement. Does this affect the statement of cash flows? Yes, it does. If it affects cash, affects the statement of cash flows. We have $300,000 money coming into the company. What type of activity? We know that anything to do with loans is a financing activity. That takes care of transaction B. Let's look at transaction C. C says AC company paid $250,000 to buy land. So now the company's buying land and paying $250,000. What happened? We know that the company had a cash decrease of $250,000. I'm going to put that as a negative number because cash went down, and you know in accounting that's parentheses. What else happened? Now the company exchanged that for another asset. What asset? Land. Land is an asset, so I'm going to have another account called land up here. And for this transaction, our land increased. We didn't have any land before. Now we have $250,000 of land. That took care of the balance sheet. Let's look at the income statement. What happened to the income statement? Well, land is an asset, so it's cash. This did not have any revenues or expenses related to it, so it does not affect the income statement. Let's look at the statement of cash flows. Statement of cash flows was affected. Our cash decreased, so we have a cash outflow of $250,000. What type of activity is this? Land is a long-term asset, therefore it is an investing activity. And I will say IA for investing activities. Let's look at transaction D. It says, AC Company received $80,000 cash by earning revenue. So for transaction D, we know they received cash for earning revenue. Cash increases by $80,000. I'm going to put $80,000 as a positive number here. Now, how does revenue affect the balance sheet? We know that revenue has the effect of increasing stockholders' equity. So what particular component of stockholders' equity? We know it's retained earnings. So let's type retained earnings here. Actually, I'm going to abbreviate it. So we know that revenues has the effect of increasing retained earnings, so I'm going to put $80,000 as a positive number there. That took care of the balance sheet. Now let's look at the income statement. Did we just have any revenues or expenses for this transaction? Yes, we did. This was a revenue item. So what happened to revenues? We know that revenues increased, so I'm going to put $80,000 in the revenues column of the income statement. And then expenses, no. But what effect does revenue have on net income? Revenues have the effect of increasing net income because we know net income is calculated by taking revenues minus expenses to equal net income. So net income increased $80,000 as a result of this transaction. Did we have any cash effect for this transaction? Yes, we did. We had $80,000 cash inflows, so that's going to be a positive $80,000 of cash coming in. What type of activity? This is what a business does day to day, so I'm going to say that would be an operating activity because day-to-day activities are considered operating activities. Now, let's go look at the next transaction, transaction E. It says AC Company paid $60,000 for operating expenses, such as salaries, utilities, and so on. So we know that if we paid for expenses, our cash decreased, so I'm going to say cash decreased by $60,000. What else happened in the balance sheet? We know that expenses have the effect of decreasing stockholder equity, specifically retained earnings. So I'm going to go to retained earnings and say that my expenses increased by $60,000, which causes retained earnings to decrease by $60,000. And that took care of the balance sheet. Now let's look at the income statement. Did this transaction affect the income statement? Yes, it did. We just had expenses. I said our expenses increased. We had no expenses before this transaction. Now we have $60,000 of expenses. So our expenses increased. I'm going to put that as a positive number under the expenses column in the income statement. I want you to be very clear and understand this. Our expenses increased by $60,000. That's why it's a positive number. How did this affect net income? Well, in the income statement, we take revenues minus expenses to equal net income. So as a result of the $60,000 increase in expenses, our net income decreased by $60,000. Pause the video, go back, listen to it, and make sure you understand that what we just talked about. Next, let's look at the statement of cash flows. We know that cash decreased, cash went out of the company, so we had a cash outflow of $60,000. What type of activity? Things like salaries, utilities, and so on are operating activities. These are day-to-day activities. Let's look at the next transaction. Transaction F says AC Company paid 8,000 cash dividends to its owners. So we know that if the company paid dividends, money went out. So I'm going to put a negative 8,000 under cash. How does dividends affect the balance sheet? We know that dividends have the effect of decreasing retained earnings, just like expenses. So we go to the retained earnings column and put 8,000 as a negative number. That took care of the balance sheet. Let's look at the income statement. Does this affect income statement? Is it a revenue or an expense? It's not. It's neither. It's a dividend. So it does not affect the income statement. Let's look at the statement of cash flows. We know that cash decreased by 8,000, so we had an 8,000 outflow of cash. What type of activity is it? Dividends are paid to stockholders, so anything to do with stockholders is a financing activity. So dividends are a financing activity. Let's look at Transaction H. Transaction H says the land that was bought in Transaction C had an appraised market value of $95,000 on December 31st, year 1. We bought it for $250,000, but it looks like there was a crash and the land went down to $95,000. Well, what do we do? Absolutely nothing. Whether land goes up or down, we don't do anything. The purchase price that we paid is the price we'll list it on the balance sheet. Assets are listed at the price paid until we sell. Now, if we sold that land, then we would make a loss and that would get recorded. But again, that's a future chapter. But as long as we're holding the land, we don't do anything. We show the land at $250,000. So we don't record anything for that transaction. That's it for this video. Be sure to rework this question until you're comfortable and you know how to do this example without looking at the answer. That's it for this video.